The rising price of gold has been one of the big market stories this year, up about 40% year to date. And with the U.S. economy facing slowing growth and lower interest rates, is the precious metals big rally likely to continue? Well, who better to ask than Bart Melek, Global Head of Commodity Strategy at TD Securities. Bart, always great to have you on the program.
Well, it's wonderful to be back, and it certainly has been a great time for gold these days. As you said, over $3,700, and an interesting factoid here: it's in real terms, inflation adjusted, even higher than it was back in the 1980s.
All right, so let's dig in with that little nugget under our belts. A steady climb for recent months to these record highs. We start thinking about what's happening here. Technical momentum versus fundamental drivers. How are you seeing this rally?
I think we're seeing a little bit of both. Of course, the market is very much responding to the Federal Reserve starting its easing cycle, where the market is looking at as many as 3 cuts this year. We're looking at maybe 2, but either way, this is quite good for gold, mainly because it reduces the cost of carry. And that's very important, particularly for the discretionary traders who, sadly for many of them, who have really missed much of this jump. We've seen CTAs and we've seen other people participate, but not so much the discretionary, the prop traders and so on. And this could very well be something that incentivizes them to move back in.
All right, so rate expectations a big part of this. What about inflation heading? I mean, we've spent so many years talking about inflation. Is this still part of the calculation?
Absolutely. Look, even today, data is showing that the economy is maybe, not as bad as some people thought. Employment creation may not be robust, but we have this situation with tariffs. We are looking at inflation at over 3% by the end of the year. And of course, the Federal Reserve target is 2%. So we are running way above target, and we're having a Federal Reserve that's really prepping to address the second part of its mandate, which is maximum employment. We could see a situation where inflation is actually increasing and the Fed is cutting, which would mean steepening of the curve, and so far very good things for gold.
All right, so some constructive things there for gold. Early in this rally, you and I have had so many conversations about this run. Central bank buying was central, I think you had argued to me, about what was happening with the price of gold. How important is it now that central banks continue to buy to sustain these levels?
Well, it's still central. Central bank continues to be central. Central banks have been huge buyers ever since 2022, where they bought well over 1,000 tons. That's not ounces, that's tons of gold. With China continuing to acquire bullion in its foreign exchange reserves, but not only China, other central banks again. Central Bank of Poland and others are buying gold. They're quite worried that you will have a Federal Reserve that may not be as committed to the 2% target as they have been in the past. You have the U.S. amassing massive amount of debt, and which is growing at at a rate of 6% plus, which ultimately has to be funded somehow. And we're seeing evidence that much of the world is trying to de-dollarize to some extent. And of course, a weaker U.S. dollar, as rates come down, potential de-dollarization is a very accretive thing for gold.
We start putting all these things together, a lower rate environment, a lot of the factors you're talking about right now. I think people are focused on the here and now and maybe what happens before the end of the year. Longer term, what are the implications of an environment like this for gold?
I think longer term, gold may very well be seen as an alternate asset to your standard 60-40 portfolio, which, of course, includes equities and bonds, and something that, if all fails, will do okay. If we see inflation and central banks keeping rates somewhat low, meaning that real returns on fixed income aren't necessarily going to be there. If equities at some point decline because the economy may not see the demand and then the large income growth, profitability drops, gold could be a good alternate. And if we see stagflation, well, gold pretty much without fail accounts for higher inflation, as it is real physical commodity that requires labor and productive capital to get out of the ground. And they're all very sensitive to inflation in essence. As inflation goes up, so does their cost, so do production cost of gold, and so does the gold price.
Right, so you've laid out a lot of very clear fundamental drivers, technical drivers for gold. What could derail the momentum for gold at this stage?
Well, I think it's always tricky. To call these markets because it's very rare that markets continue to go up without any disruptions in between. You can be as positive as you want, but CTAs, for example, which are algorithmic trend followers, are very, very long here, 70%, I think, of maximum long exposure. And these guys are driven by volatility. So if we at some point see volatility increase in these markets with geopolitics the way they are, that could very well happen. You could see selling despite of the fundamentals, just as people adjust their so-called value at risk levels.
Quickly, I'll ask you, we put all that together, where could gold go from here? I think during this rally, some people are asking themselves, how much higher can we go? Can we go much higher from here?
Well, between you and I and the audience, we were calling for $3,700. At the beginning of next year, we're there already. We were also on record as saying, in fact, with my and yours chats, that we could see 4,000 from a trading perspective. I think 4,000 is very well possible if we see the Federal Reserve indeed starting and continuing its cutting cycle, geopolitics remaining volatile, and inflation staying stubborn. We could, I think, without great difficulty, seeing $4,000 by early next year. However, that doesn't mean that it's going to go there directly in a linear manner. We could see up and downs and corrections in the interim.
Bart, let's jump into the price of crude. Stuck in a range, unable to sustain any rallies. What's happening out there in the market right now?
Well, I think for the most part, this market is doing relatively well. We're, I think, over $64 as we speak, due to geopolitical tensions and events in Russia, where their latest response to the upside was Ukrainian strike on Russian oil refineries, refinery facilities, I should say, rather. The continued promises or threats, I don't know what to call them exactly, from the White House that they are going to implement some sort of tariff regime, not sanctions, I understand, against the consumers of Russian oil. None of this has materialized, but we are seeing an impact on the refined product market, which ultimately will mean that non-Russian crude requirements may be higher than otherwise, because you're going to have to try to make that deficiency up somewhere else. So geopolitics and these military attacks are having an impact. I would have thought that oil, WTI in particular, should be at below $60 at around 58 or so. We're higher because of those tensions.
When we talk about those tensions, obviously people have been watching them very closely for a while and the actual impact they have on supplies. So you're saying there actually is now an impact. Because I think before, when there had been escalation, the market started to say, well, show me the disruption. Show me the supply disruption. Are we seeing it?
Well, we are seeing evidence of facilities burning. That means, those refineries would have used Russian crude. And that Russian crude may not be available for other refineries with spare capacity. So you're going to have to stress other parts of the market, which could, leave the market a little tighter than otherwise. So we are seeing. I still think it's nowhere near enough to offset what we're seeing on the fundamental supply and demand imbalance, very much tilting towards oversupply. But on the margin, it's having it's having an impact, and markets are paying attention and adjusting for that risk.
Let's talk about the demand side. Obviously, we have worries about global growth, worries about growth in the world's largest economy, the United States. How much of all this is cyclical versus structural?
Well, I think right now much of it is cyclical because a lot of the structural stuff already has happened. Vast majority of the demand growth is really from the non-transportation sector. But cyclicality does matter. We are looking at somewhat slower activity globally. The U.S., is one. China, another, where we're going to see demand probably not much more than 680, 700,000 barrels a day increase this year. Probably not much more next year, and we're continuing to see more supply coming from not only OPEC but also Latin America and certainly Canada. And look, and shale is still this year going to produce more than it did last year, though next year we're probably going to see a decline.
What is going on with OPEC Plus right now, agreeing to more production hikes? What do you think they're playing at?
Well, I think there are two things happening. They want to signal to the market that they're back in and that the world has normalized. They want to unwind the post-COVID reductions, certainly the 2.1 million barrels per day of the so-called, voluntary reductions. But I think to a great extent, this is, a paper increase where they're matching the quota to already what is happening on the ground, to facts on the ground. So we haven't really seen much more than 1.2, 1.3 million barrel increase over the last 12 months or so, which is less than the announcements because what we're hearing is the announcement in quotas, not exactly production. So we're already seeing that production happen, and they're just adjusting the targets.
Very interesting stuff. Bart, got about a minute left with you, but I ask you quickly, what catalyst could break oil out of its range?
Well, downside or upside, I guess it depends. Certainly to the upside, if we see the U.S. take very robust measures against Russian crude and OPEC decides to no longer continue its expansion of production. But that I think we would have to see lower prices first before OPEC changes its mind. But I'm not very convinced that U.S. will take action that voluntarily or is designed to hike the price of gasoline in the United States. So, but those would be the catalyst, but I don't think it's likely to happen.